As the banking crisis rolls on and arguably gets worse, here's a fresh new take on what might be at the root cause of this. It's that it wasn't a failure of regulation or that there wasn't enough regulation. It's that the regulations that have been in place for years, and there are tons of them, weren't being properly enforced. The person who's putting that theory forward is Manthos Delis. He is a senior lecturer in banking here at Cass Business School. Manthos, what's the evidence for this?
We do find, Alex, that regulatory effectiveness is a major issue when it comes to bank regulation. Regulatory law on the books is what Basel is putting forward as the major element in containing bank risk. But what we do find is that actual implementation and effectiveness of law on the book is what matters more in containing bank risk. And we do have evidence for that coming from a number of countries, a number of Western-type economies, which suggests that in the period prior to the financial crisis, regulatory effectiveness decreased in terms of audits and sanctions.
So in a way, there are parallels here with crime statistics. It's not that you need more laws. What you need is the police to enforce the laws that are there and actually go out and catch criminals.
This is exactly right, Alex. We believe that under Basel II, what is actually suggested from Basel is that we have new laws effective to contain bank risk and to promote prudential activities of banks. But this does not seem to be the case. We don't need a very strict regulatory environment for banks. What we do need is that the supervisory agencies, through the special agent that they have, they go on and actually enforce law on the book and actually preserve the banking system from a new crisis in this way.
Because it's actually, what you're saying is an argument for simpler laws. The banking regulations that exist at the moment, if you were to print them all out, would make a pile that goes up to the moon. What's needed are simple rules that everyone can understand and that the regulators can enforce easily.
This is exactly right. We do believe that simple rules should be in place, and banks know exactly what is expected from them, and banks comply with these rules, and they have the incentives to comply with these rules based on the fact that auditors from the regulatory agency actually implement existing law on the books. And this is very important. This is the single most important element in our research that contributes to a stable banking system.
Just to finish, does that mean that perhaps there were actually too many rules, too many laws in the past, and that's what led to this crisis?
This probably contributed a lot to the crisis, and there were incentives for the banks to go about and do that, to take on higher risks. One element is probably a capacity issue within the regulatory supervisory agency because of the financial engineering and developments in the banking sector over the past. It was a huge innovation in the financial sector, and probably the regulators could not cope with this major change. But there was also a political change following the hit on the towers in 2001, which led politicians to lax regulatory effectiveness. And we can see that this contributed to this decrease in the number of enforcement actions in the US in the period prior to the financial crisis, which we believe is a major element that contributed to the financial crisis that erupted in 2007 in the US and indeed led to the ongoing recession.
Once again, don't look at the city. Actually, the fault was with the politicians.
Exactly.
Manthos Delis, thank you very much.
Thank you very much, Alex.